There are 88 million ounces of silver sitting in the COMEX vaults right now. There are 652 million ounces worth of paper contracts stacked on top of them. And in 3 days, the people holding those contracts get to demand the real thing. That is the math. It does not work. It cannot work. And, as of this morning, the one force that was keeping the lid on this pressure cooker just came roaring back online. For 10 days, the Shanghai Futures Exchange sat dark. Lunar New Year. The second largest precious metals market on Earth went silent, and during that silence, every short seller on the planet had room to breathe. No Chinese industrial demand. No institutional hedging out of Asia. Just a quiet window where the paper market could operate without confronting the physical reality underneath it. That window closed this morning. Shanghai reopened, and the first thing Chinese buyers did was reach for silver, not gold. Gold is down 0.5% today. The dollar is flat. Equities are sideways. Silver is the only major asset climbing, up 1.44% intraday, punching above $32 while everything else treads water. When the world's largest industrial consumer of silver walks back into the market and the metal immediately separates from every correlated asset. That is not a coincidence. That is a signal. And it is pointing directly at Friday, February 27th. Friday is first notice day on the March COMEX silver contract. It is the deadline when anyone holding a futures position must formally declare whether they want cash or metal. And the number of contracts still open on that book dwarfs anything the exchange has the inventory to honor. We are not talking about a theoretical stress test. We are watching the math collapse in real time, one vault report at a time. And the next 3 days will determine whether the paper silver market survives this month with its credibility intact. If you hold PSLV, what happens between now and Friday morning is not abstract. It is structural. And by the end of this breakdown, you will know exactly which numbers to watch, exactly when to watch them, and exactly why the structure of what you own matters more this week than it has at any point in modern silver market history. To understand why this Friday is different from every other first notice day, you need to see what has been draining out of those vaults for the past 5 months. Because the crisis did not start this morning. This morning is simply when the rest of the world started paying attention. Go back to October 2025. COMEX registered silver inventory stood at 167.7 million ounces. That is the metal earmarked and available for delivery against futures contracts. It is the number that underpins the entire credibility of paper silver pricing. And since October, nearly half of it has vanished. The drain did not happen in a single dramatic event. It happened methodically, relentlessly, in daily increments that barely made headlines. Physical buyers, industrial users, institutions with long-term demand horizons, they took delivery and they did not return the metal. Week after week, the registered category shrank. By early February, something crossed a threshold that had not been breached in years. On February 11th, registered inventory fell below 100 million ounces in a single session. Over 3.2 million ounces were pulled from the registered category that day. The following session, eligible inventory dropped another 4.7 million. 2 days, nearly 8 million ounces gone, and the pace did not slow. As of the most recent CME Vault report on February 19th, registered silver stood at 88.79 million ounces. The average daily drain rate, calculated from public delivery data, is running at approximately 785,000 ounces per day. At that pace, the vaults hit 85 million ounces somewhere between tonight and tomorrow evening. Now stack the paper on top of that shrinking base. March open interest as of February 19th sat at 130,490 contracts. Each contract represents 5,000 ounces. Multiply that out, and you are looking at 652 million ounces of theoretical claims resting above a vault holding less than 89 million ounces of deliverable metal. The coverage ratio is 0.1. For every single ounce the exchange can actually hand over, 7 ounces worth of paper promises exist above it. If this kind of analysis is sharpening your understanding of what is really moving beneath the surface of this market, hit like and subscribe now. Because what comes next is the part most coverage is not showing you, and it changes the entire calculus of what Friday means. Here is the number that makes February historically unusual. During the February delivery window, approximately 46 of 100 contracts stood for physical delivery out of roughly 47,000 open interest at the close. The raw delivery data from COMEX public notices shows physical demand at levels that dwarf any recent precedent. In a normal month, delivery rates run between 5 and 15%. What happened in February was structurally different, and it is fully documented in the exchange's own filings. If even a fraction of that intensity carries into March, the registered inventory cannot absorb it. And that is before we add the variable that just re-entered the equation this morning. Before Shanghai closed for the Lunar New Year, the situation inside China's silver market was already acute. Inventories on the Shanghai Futures Exchange had fallen to approximately 353 metric tons, a level not seen in a decade. Withdrawals were accelerating, and despite those critically depleted reserves, the SHFE price was trading at a premium above COMEX. Chinese industrial buyers, solar manufacturers, electronics firms, institutional accumulators, they were paying more than the New York screen price to secure immediate access to physical metal because physical metal in China was genuinely scarce. Then, the exchange went dark for 10 days. And here is what most analysis misses about that closure. Demand did not disappear, it compressed. 10 days of industrial purchasing, 10 days of hedging adjustments, 10 days of institutional rebalancing, all of it queued behind a locked door, building pressure against a global physical market that was already running at structural deficit. This morning, that door opened. Silver responded immediately, separating from gold, and the broader commodity complex in a way that isolates the source of the buying pressure. This is not speculative momentum. This is physical demand from the world's largest silver-consuming economy re-entering a market that spent the last week and a half pretending that demand did not exist. Now layer the COMEX situation on top of Shanghai's return. The exchange is heading into first notice day on Friday with a registered inventory that has lost 37% of its volume in 30 days. Chinese buyers are back and accumulating below what they clearly view as fair value, after watching silver touch an all-time high above $121 in January before the paper-driven correction dragged it towards $72. The February delivery month demonstrated physical demand at historic levels, and 130,000 contracts are still sitting on the March book. The arithmetic does not require interpretation. If 25% of March open interest stands for physical delivery on Friday, that represents 32,600 contracts. At 5,000 ounces per contract, that is 163 million ounces of demand, aimed at a vault holding less than 89 million. The exchange cannot deliver what it does not have. And every institutional desk that understands futures settlement mechanics is staring at the same numbers you're staring at right now. What most people do not realize is that COMEX has a contingency for exactly this scenario. And understanding that contingency is the difference between panic and clarity when Friday arrives. Buried inside the COMEX exchange bylaws is Rule 589. It carries an innocuous title, Emergencies, but its function is extraordinary. If physical delivery becomes impossible, the exchange can invoke force majeure and compel cash settlement. Contract holders who demanded real silver receive dollars instead at a premium to spot, and the exchange continues operating. Legally, it is not a default. Functionally, it is the moment the paper market confesses that it cannot back its own promises. There is precedent. In March 2022, the London Metal Exchange faced an identical structural failure in the nickel market. A massive short position blew up, physical delivery became impossible, and the LME halted trading, canceled billions in executed trades, and forced cash settlements. The exchange survived as a legal entity, but its authority over global nickel pricing was permanently damaged. The UK Financial Conduct Authority later imposed nearly $12 million in fines for the handling of that crisis. The LME kept its license. It lost something more valuable: trust. If COMEX reaches the point where cash settlement is invoked on silver, the immediate consequence is a severing of the paper price from the physical price. The screen number becomes a reference point for cash settlement, a fiction that represents what the exchange is willing to pay, not what an ounce of silver is worth to someone who needs it. The physical price becomes whatever a holder of real metal demands from a buyer who has nowhere else to go. And that repricing cascades instantly into every asset that sits on either side of that divide. This is the question that should be occupying every silver investor this week. If the exchange of last resort cannot deliver, what happens to the premium on every ounce that exists outside its system? And where does your holding sit in that repricing? Paper derivatives, futures contracts, unbacked ETFs, options, they are all tethered to the exchange's settlement price. If that price disconnects from physical reality, they follow the fiction. PSLV operates on a fundamentally different architecture. The trust holds 210 million ounces of allocated, audited physical silver at the Royal Canadian Mint. The metal exists independently of any exchange's ability to source or deliver. If the physical premium detonates because COMEX cannot honor its contracts, the net asset value of the metal inside PSLV reprices with the physical market, not the paper one. Think about what happened during the January correction. Silver crashed from above $121 to approximately $72. PSLV traded at an 11.6% discount to its net asset value. At the exact same moment, physical dealers were charging 30 to 40% premiums above spot on American Eagles. The paper market was in freefall. The physical market was screaming that real metal was scarce. That gap between paper panic and physical reality was the single most important data point of the entire correction. And by February 20th, that discount had already compressed to 3.62%. Today, with Shanghai back and silver climbing, it is tightening further. If PSLV crosses from discount to premium, it means the market is acknowledging that physical exposure through an allocated trust is worth more than the paper spot price. That has happened before in previous demand spikes, and it is a pattern worth understanding, not predicting, but recognizing if it appears. Between now and Friday morning, there are 3 specific inflection points that will tell you whether this situation is escalating or stabilizing. Know them before they arrive. Tonight, Tuesday evening, approximately 6 p.m. Eastern, CME publishes its daily vault report. That report will show how much registered inventory moved on today's delivery notices. If the number drops below 85 million ounces, the margin between deliverable metal and outstanding paper claims compresses further into territory that has no modern precedent. Wednesday brings the first full overnight session with Shanghai, actively trading alongside Western markets. 2 consecutive sessions of sustained Chinese institutional buying would confirm that the demand compression from the 10-day closure is releasing as a structural shift, not a single-day reaction. Watch the Globex silver ticker Wednesday evening from 6 p.m. Eastern as Asian markets come online. Thursday evening is the final data point before the deadline. The updated March open interest figure will reveal whether large funds have been quietly reducing exposure through rollovers or early cash settlement. If that number holds above 125,000 contracts heading into Friday, the delivery demand against registered inventory becomes structurally impossible to satisfy at current levels. Those are your 3 markers: tonight's vault report, Wednesday's overnight session, Thursday's open interest. Now, here is what the structural picture actually looks like for the position you hold. PSLV is an allocated physical trust. The silver inside it does not depend on COMEX's ability to source metal. It does not depend on a custodian's paper obligations. It sits in Canadian vaults, audited by third parties, verifiable by any shareholder. If Friday produces a sharp paper sell-off, while PSLV maintains its net asset value or trades at a premium that is the physical floor, holding the same pattern that played out during the January correction when physical premiums stayed elevated while the paper price collapsed towards $72. If Friday produces an actual delivery disruption announcement, that is an entirely different event, one that would be historic in the literal sense. The math on paper makes it structurally possible in a way it has never been before. That is not a prediction. That is what the exchange's own published data says when you do the arithmetic. The paper-silver market was designed to function on the assumption that most contract holders would never ask for the metal. That assumption held for decades. It held through cycles, through crises, through every stress test the market produced. What is different now is that the assumption is being tested not by speculators, but by industrial demand from the world's fastest-growing manufacturing economy, by a delivery month that shattered historical norms, and by a vault inventory that has lost nearly half its registered base in less than 5 months. The system was built on the premise that the metal would never actually be demanded. The metal is being demanded, and the vaults are answering with silence. 3 days, 3 data points, and a question the paper market has spent 50 years avoiding. What happens when they come for the silver and it is not there?